Good evening, everyone, and welcome to the Money Show right here on ET Now. Remember, this is the only daily show where we bring the top market financial experts in order to help you answer your financial queries. I'm Avan Dabash. Let's bring on board our expert for the day, and joining in, we have with us Mr. Harshvardhan Roongta, CFP Roongta Securities Private Limited. Lovely to have you with us in our studios. So much to discuss over the next half hour, but Harshvardhan, let's get down to business and talk a little bit about the importance of hybrid funds. Now, given the kind of volatility that we're seeing in the markets, as well as the kind of valuations and PE, you believe that it is fairly important to look at hybrid funds. Start off by explaining to us the importance and the significance of this in a market like this.
So Avan, you're right when you say that we're looking at a market valuations which are of a multiple of about say 25 times currently, and historically we've seen that these levels are high, and this is not the real time to get into stock market. However, when you look at the potential of the Indian economy going further, I mean, you would really be stupid if you do not invest in the economy of the country. So how do you balance both? So here is where you will have hybrid schemes which are a combination of equity and debt. Now, when we talk about balance fund particularly, why we talk about balance funds? Because they invest about 65% into equities. That's the minimum that they have in equity, so that it can be classified as an equity fund for the taxation purposes. Otherwise, an hybrid fund would have a combination of equities ranging from 5% going up to say probably 70 or say 80%. Now, because of taxation purposes, balance funds maintain a minimum of 65% in equities. Now, why does it become essential at this stage to look at balanced funds? As I said, we have a high valuations in the market which are not suggestive from investment purposes. At the same time, we have a growth potential for the Indian economy. So you need to take a balanced approach, and you have to have exposure into equities. At the same time, be cautious about it. So we have balanced funds for new investors, because we've also seen historically when the markets reach their peak or when they are in a consistent bull run, you will have new investors coming in. Now, if that is the situation, they need to be cautious and they need to enter with little apprehension about where the investments are going to head. So balance funds work very well with new investors. They also work very well in case you wish to invest a lump sum. Now, if you have a large corpus which you need to put into the market or you need to invest, a balanced approach would be highly recommended at this stage.
Right. So Harshvardhan, let's get to our first query coming in from Pradeep Kumar. He says that he started an SIP of 2,000 per month with ICICI Value Discovery Fund 9 months ago. Can you tell me the future of the fund? Should I continue to stay invested? So essentially, as far as this particular fund is concerned, Harshvardhan, if you can guide him on what he should be doing, whether to continue with it or to look at switching perhaps.
So well, the ICICI Value Discovery Fund is a highly recommended scheme, even as far as we are concerned. Now, when you look at the structure of the scheme, they're very particular about picking up stocks. As the name of the scheme suggests, it's a value discovery fund. So the primary objective is to find value and then invest into those stocks. I'm not saying they do not take growth-oriented calls in the portfolio. They do that, but the underlying phenomena is always going to be towards value discovery. They're going to be investing into value stocks. The methodology adopted by them is a price to book valuation, and based on which they construct the portfolio. Now, being a multi-cap scheme, they're truly sticking to that concept of being open to investing in any market capitalization. Earlier, the scheme had a weightage on mid caps, but as the valuations got very expensive for the mid cap space, they moved to the large cap category. So they are predominantly a large cap with about a 20% into mid caps. So well, for Pradeep, the suggestion is that he should continue investing into the scheme without any worry.
Okay, no worries there. ICICI Value Discovery Fund is on the recommendation list. It's grown quite rapidly, and this is one to continue to stay invested. Pradeep, I hope we were able to help you out with your query. Well, we have another Twitter query, and this one has been sent in from Shilank Jain rather. He says, please can you suggest a mutual fund? This is for my retired father with a medium risk profile. So, it would be important to look at this from a slightly rounded perspective. We don't have too many details as to what are his other sources of income. But can you give us, Harshvardhan, a rounded approach to how you would be able to help him out?
So you're right. We do need to look at an holistic, picture when you talk about asset allocation or financial planning for retired individuals. Now, why does it become especially very, very critical for a retired individual? Is because the active income, the income because of employment has stopped. Now, whatever you're dependent upon is only on the corpus that you've accumulated over a period of time. So there is very less margin errors. You really cannot go, you cannot try something, go wrong, and then come back again, because as I said, your income has stopped, at least from active employment. So my suggestion is when you look at planning for retirement, it is essential that a detailed analysis be made on several aspects. It could be the health status of the individual that we're talking about, because if the health status is fragile, then you might need to set aside a lot of money for health purposes. You need to look at whether he's a pensioner, whether there is some source of income coming in the way of pension from the employer. You need to look at the expenses that the person incurs. Is there a spouse dependent on, is there a couple dependent on this income? So there are a lot of things that need to put into place before we suggest something for a retired individual. So in this particular case, my recommendation is that a one-to-one meeting with a financial planner, having a detailed analysis of the entire situation is important. You must also include and involve your father in the process, because he's the one who's eventually going to live with that investment, and he needs to be comfortable. Many times we've seen, as children, we believe something else is good for them, but if they are not comfortable, it worries them. It doesn't make sense to go ahead and do that. So involve your father in the process, take a one-to-one consultation with a financial planner, and then possibly drop a plan. That would be an ideal way to go about for you.
Right, Harshvardhan, just extending that particular question, because retirement investing is something that a lot of people, of course, would need guidance on. How would you suggest going about planning your retirement? Because there are several different investment avenues that are available today in the market, whether it's mutual funds, the NPS, etc. What would be the process one should follow, and when should one begin retirement planning?
For the question as to when should a person begin his retirement planning, it is from his first day of job. So because retirement is a definite event to happen, irrespective of what happens, whether you're able to save for it or not, there is going to be a time when nobody's going to employ you, or you're not going to be employable in that case. Your physical ability to work reduces over a period of time. So you're going to be constrained from working and generating income for yourself. The earlier you start, it becomes far more easier for you to then plan and accumulate that corpus for yourself. Now, so that answers your question on when should you start saving. The other question is then how should you go about doing it? So there are multiple options. As you mentioned, one is an NPS. So this is a structured pension product. So if a person is not financially savvy, is not good with managing money himself, this is a simple product. You put your money into NPS, you let it accumulate over a period of time, which is up to 60 years of age. At 60, you're given a choice to withdraw certain amount as lump sum out of it. So at 60, you're allowed to withdraw 60% of whatever accumulated corpus is available as a lump sum for your immediate requirements. The balance 40% gets transferred into a licensed insurance company, and an immediate annuity plan has been bought out of that. And after which you will get a regular pension. Now the question is, if this is one structured method, there is another way that you can go about doing the same thing. You could invest into an equity mutual fund and you just accumulate that corpus over a period of time at your age of 60. Now that entire corpus is at your disposal. What you could do with that corpus at that point in time, it depends on what you like. So for instance, a simple example is you've accumulated a corpus, you remove that money, put it into a fixed deposit which gives you interest on a regular basis. That is pension for you. You would remove that corpus, or you buy a property with it and earn rent income on it. So that is regular income post retirement. You could consider that as annuity. So there are several options depending on individual profiles. If you're good with managing money, you should do it yourself. If not, then NPS is another a very good option in the low cost structured pension space.
All right, so that's a view coming in as to what you can look at for options when it comes to planning your retirement, what would be appropriate to start. But I think Harshvardhan was fairly categorical in saying that you need a detailed analysis on the kind of action plan, on the expenses, etc. So detailed consultation is definitely advisable. Well, you ask, we answer, and we have another query coming in on Twitter from Jason, and it's a fairly categorical question. He asks, can you explain what systematic transfer plan is in detail? Because he doesn't have a regular monthly income. Would this really apply, Harshvardhan, a systematic transfer plan for someone who doesn't have a regular monthly income? And can you explain as well what it is?
So well, this is quite interesting because we've been talking about, and investors on an individual basis understand the concept of SIP very well now. Now it's nice that we listen to investors asking questions about STP, which is a systematic transfer plan. So well, there is a slight confusion which I'd like to correct at this stage. So systematic transfer plan is not really designed to give you regular income. Systematic transfer plan is when you transfer money from one scheme to another. So let me just bring this down into all three terminologies that we've been hearing all the while. So what is SIP? If I may just briefly sum it up. You have, suppose, 1,20,000 rupees to invest. You let that money lie in your bank account, and every month you instruct the fund house to pull out 10,000 rupees. So over a period of 12 months, this 10,000 rupees every month, and that 1,20,000 will get invested into equities, because we believe in equities you should not put money into as a lump sum. So this is an SIP where typically money is pulled out of from your bank account. Now, systematic transfer plan is an extension of this. So as we mentioned, you had 1,20,000 rupees to invest. You do not want to leave it in your bank account, because what you really get over there is just 3.5%. And there's a great possibility in investor behavior that if the money is in your bank account, you might land up spending it. So what do you say? You say, I wish to just move this money out of my system. It should not be in my bank account. It should not be available to me. And at the same time, I do not want to invest as a lump sum in equity. So what do? You put this 1,20,000 rupees in a liquid fund or an ultra short term fund which does not have any equity exposure. It is a liquid fund. It's a debt scheme on which you generate whatever returns that the scheme generates, which is about 6 to 7% returns. Now from there you instruct the same fund house that pull out 10,000 rupees from this liquid fund and invest in the equity scheme that I am advising you to do so. So instead of the money being pulled out of your bank account every month, which is an SIP, here you will have 10,000 pulled in, transferred from one scheme, which is a liquid fund of the fund house, into another scheme, which is an equity scheme. So you're doing an SIP, however, the money is not getting pulled out from your bank account. So that is systematic transfer plan. Now what you're really looking for is a regular income. So now that is a systematic withdrawal plan. That's an SWP. Now what does an SWP do? It's an opposite of SIP. While in SIP you were depositing 10,000 rupees with the scheme, here you're going to instruct the fund house. You already have a corpus invested into a scheme. Now you're going to tell the fund house that please give me a fixed sum of money every month in my bank account. So that's a reverse way where the fund house is going to give you a fixed amount every month out of the corpus that you have. So SWP is exactly what you're looking at. In this case, you need to have a corpus accumulated in a mutual fund, of which you then give them an instruction. Every month a fixed sum of money will be redeemed out of the scheme and given back to you in your bank account. So that will enable you to get a regular income. That what you're desiring. So this also was, linking it with the retirement that we spoke about. We have many individuals who can accumulate corpus over a period of time into a mutual fund. They do not need that money at retirement in one lump sum. So you let the investment be as it is, and you set up a SWP out of it. So you tell the fund house every month my requirement is an X amount, and you please redeem my fund and credit it back into my account. So that enables you to get a regular income post retirement as well. So three terminologies: SIP, SWP and STP. So there are three different things. I'm very glad we have investors talking about these and understanding these mechanisms which are available in the mutual fund space.
Right. Harshvardhan, just for one more step of clarity in this, all these three terms that we just spoke about, as far as the systematic transfer plan is concerned, is it fair to say that if somebody has a large corpus looking to be invested into equity mutual funds, it's better to sort of put it in the entire corpus in a debt fund like a liquid fund you were mentioning, and then do a transfer into your equity funds?
Absolutely. In fact, when we interact with investors, the biggest problem is that they do have a lump sum with them, and if they were to do an SIP, which means that the corpus still remains with them in their control. So there is a great fear that they might land up spending it for the immediate requirements or for some holidays maybe, or for a renovation of their house, because the money is lying available with them. Now STP enables you to get rid of that money from your account. It gets invested in a product which is giving you more than your bank account, and also at the same time helps you to invest in equities via SIP, which was your original thought. So STP is a wonderful product for people who have lump sums amount available with them. It comes handy when you get bonuses. Now we have festive season coming up. We will have employees getting Diwali bonuses. We will have performance linked bonuses coming at the end of the financial year. So these are the times when you can just park that money aside. Don't keep it with you in your hand, and then also at the same time invest via SIP. If I may say, STP equivalent to an SIP, where money gets pulled in from your one account or one debt investment into equity. So that in fact is a very useful tool for financial management.
Okay, thanks very much for that, Harshvardhan. Let's move on to another concept that I'd like to discuss. And you interestingly put it that come the month of December, we start getting calls from the accounts team to get going with our taxes. So I just want to understand a concept that everyone would really relate to. Should one invest only to save tax, because that rush does begin in a few months from now?
Absolutely. So this is in fact a very interesting time that we are in, because come December we will have all the employers, the accounts department, sending out reminder mails that you've made certain declarations at the beginning of the financial year of certain investments that you're likely to make. So please submit the proofs of those investments. Otherwise, we will have to deduct tax in the next quarter. That is the first quarter of the financial of the calendar year. Now, invariably we've seen that if you haven't made any investments till now, you haven't really planned well. What you will end up doing is you will buy something that is available to you, that is conveniently available to you, because there is a deadline of submission of proofs. You might just catch hold of somebody who's going to help you invest your money, say in an insurance policy or certain post office national savings certificates or bank deposits. So what you will end up doing is that you will buy something, invest into something only from a perspective to save tax. However, when you make an investment, there is a purpose behind it. There is a life goal that you need to be allocating these investments to towards. Now let's understand the situation. If I give you an example for tax saving purposes, if you make certain investments only for tax saving purposes, how it can go horribly wrong. Now say for instance, you've taken a housing loan. You have a house of your own, but there was an intent to save tax, at the same time also invest. So a popular method is that you buy a second home, and the interest that you pay on the housing loan is deductible under section 24. So what happens is you'll end up taking a housing loan for about 20 years. And there is an interest component to this on which you're taking tax benefits under section 24. Now there is nothing in the law that prohibits or prevents the finance minister from repealing the section 24 henceforth. So you've landed up, what happens if the interest that you're paying is not eligible for tax benefits coming 2 years or 3 years from now? You've landed yourself in a loan which is for 20 years and the tax benefits are not going to be available for that long. So however, the objective has to be, you have to invest to serve certain life goals, to achieve those life goals, which could be retirement, could be children's education, could be your holiday, there could be whatever reasons. You need to invest to save for that purpose. And interestingly, every investment type, if you are a conservative investor, there is a product that is available which also helps you save tax. If you are saving for retirement, for example, we know equities is a good product to save for a long term. Now, if you wish to save for your retirement and you want to invest in equities and you want to do an SIP, that's your objective. If you also want to save tax, there is a product available in that basket as well, which is the ELSS scheme. If you do not need to save tax, you can invest in a regular open-ended fund. So the underlying message being, you start and your objective should be to save for a life goal. And any product that you choose, if you're choosing a debt scheme, you have a PPF, you have your bank fixed deposits, you have national savings certificates that help you save tax, also be in the debt category. On the other hand, if you wish to save for long term, equities is the class to be, you have an ELSS fund. So do not save only for tax benefits. Tax benefits are annual. However, your objectives, your investment goals, your life goals are going to be long term. So do not confuse both. Always stick to investing for your life goals and choose a product that also gives you tax benefits, not only tax benefits.
Okay, that's some advice and pearls of wisdom to really go by, and the importance of saving and overall for tax as well. On that note, let's take a quick break. Stay with us on the other side. We will have Harshvardhan Roongta joining in on the other side as well to answer a lot more queries.
You're watching The Money Show, and with us today is Harshvardhan Roongta to answer all your personal finance and investment related queries. Harshvardhan, we have a lot of queries that are coming in, but before going to the next query, I want to pick up from what we were talking about before the break, that is the tax planning part of it and how people usually rush to invest without figuring out what they actually need. Now, one important aspect here is the insurance, because insurance is one thing which you usually see people rushing in the last few months of the fiscal, running to buy insurance for tax purposes only, and that could be extremely detrimental to their entire investment portfolio. If you can just take us through why that's a problem and that should not be done.
You've actually hit on the right note. I was avoiding to use a specific insurance sales during the quarter. However, you need to understand the importance of insurance first. So let's understand what is insurance, how does it help you. So if there is an earning member of the family, on whom there are a few dependents, you must understand that if that income that you generate does not reach the house, and it could happen because of n number of reasons. I mean, we know death is certain, we do not know when will it happen. So if that was to happen to an earning member of the family, what happens? to the finances of that family. Well, nobody can replace you emotionally. However, you can replace yourself financially. Now, what happens is you buy insurance for that purpose, to protect your family against any financial stress that they might face in case you are not there as an earning member. So that is the purpose of buying insurance. Now, I fail to understand why people would wait till the year end, to the financial year end, to buy insurance. Because if you need to secure your family, you need to do it right away. You do not need to prove anybody, even if, let's understand a situation. If there was no tax benefits available on insurance, would you not buy insurance for yourself? You would still go ahead and buy. Now, let's look at the other way. Why is the government offering you tax benefits on certain products and not on every investment that you make? Because the government wants to encourage you to invest into products which are good for the nation, which are good for you. So when you talk about long-term investments, they're essentially going to fund infrastructure projects, which is good for the country. Now, when you look at buying insurance, paying premiums for your Mediclaim policy and getting tax benefits, the government wants to encourage you to protect your own self. In case you're hospitalized, you should be able to take care of your hospital bills, and you're entitled to good medical treatment. Now, that can happen only if somebody is going to fund it, either yourself or an insurance company. So there is a separate section under section 80D which helps you save tax for Mediclaim premium that you pay. So this is the purpose of insurance. Now, if you're going to wait for your accounts department to remind you that you need to take care of your family, please pay up your insurance premiums and show me the proof, then you're extremely, you're on the wrong path. So please do not wait till the last moment. Why do people buy insurance? Because there are a whole lot of people selling insurance, and that is why you'll come across somebody in your family who is an insurance advisor. So that is convenience, as I mentioned. You invest because of out of convenience, not because of suitability. So you might land up picking up a wrong product, even if it's insurance. Start planning your investments, your insurances well in advance. As I said, you invest for your life goals. You do not invest to only save tax. However, if you invest into an insurance or buy an insurance policy where you pay certain premiums, you are eligible for deduction under section 80C. So do not wait for that last day. Do not wait because you will not possibly get the time to evaluate the right kind of insurance that you need to buy. So you might land up buying something which is inappropriate in your portfolio. So yeah, well, that's what is important, and I'm glad you picked up this topic for the day.
Yeah, it certainly does assume importance, and I'm sure a lot of people will be guilty of the same. So thanks very much for clearing the air there. Next up, we've got another query, and this is more towards home loans, etc. So let's get in Ranjan Gupta's query. He sent it to us via Facebook. He says, if I go for a home loan, should I go for the fixed interest or the variable interest rate loan? So Harshvardhan, start off by just, describing for us what each of these mean and what would be the most prudent step that Rajan should take.
So when you look at taking a home loan, the lender is going to offer you two options. One is that whatever loan that you take, the rate of interest that is going to be charged on that loan for the entire period is going to be fixed. So that is the fixed rate. So you may possibly have a 10.25% or an X interest rate which has been levied onto your account, and that is the interest rate you would pay for the rest of the period as far as the loan is going to be outstanding. On the other hand, we have a floating rate or a variable rate of interest, wherein whatever in the interest rate in the market, it could be high, it could be low, it could move on both sides over a period of time. You will be paying certain interest rate based on that interest rate in the market. So, in a reducing interest rate scenario, it is always better to have a floating rate or a variable interest rate, because you're going to get benefited with the rates going down in future. Now looking at the scenario that we are in, you've seen the government is very clearly focused on reducing interest rates. The RBI has been taking steps to curtail the interest rates so that they come down. On the other hand, we've also seen RBI being very particular about these rate cuts being passed on to borrowers. So if you have to consider that scenario in the present situation, it is always advisable to go for a floating rate loan, because we are assuming that the interest rates will keep going down even in the future. The other aspect that I'd like to support this argument is also, if you study the interest rate, in the developed markets, they're almost at a zero level. I mean, they could be 1 or 2%. In fact, even negative in some countries. So if India was poised to be a developed market in the next couple of years, we cannot sustain this kind of a situation with a very high interest rate scenario. So interest rates are going to come down, interest rates are going to remain low, and at this juncture, in case you wish to take a housing loan, it makes a lot of sense to go in for a variable interest rate loan, because as and when the interest rates go down, your EMIs will also come down, or the net interest burden on you will also come down. So yes, stick to a variable interest rate loan that you're going to apply for now.
Absolutely, Harshvardhan. That's a really important thing to remember, especially in a falling interest rate environment. But also staying with this topic, Harshvardhan, just one more question. With respect to the tax implications and how you can actually save taxes when you have a home loan as far as the repayment and the interest component is concerned as well. If you can just take us through that.
So, well, the principal amount that you're paying, repaying of the loan that you're repaying is deductible under Section 80C. So that section is cluttered with, you have your insurance premiums, the NSEs, the life insurance policies, you have PPF, everything clubbed into that Section 80C, which is up to 1,50,000 per annum. Besides this, the interest that you pay on this housing loan to a qualified institution is deductible under Section 24 and up to 2 lakh of rupees. So, if you are a total outflow in a year on interest solely on interest, even if it's 3 lakh of rupees, the tax benefits that you get is up to 2 lakh of rupees. And the principal, as I said, is deductible under Section 80C. So these are the tax benefits that are largely available in a housing loan that you take.
All right, and Harshvardhan, the next query that's coming in is from Hitesh, who wants to know about infrastructure investment trusts and whether that's a good investment option for him.
So, well, when we look at the infrastructure investment trust, I mean, in a very close sense, it is like a mutual fund where sums of money is collected from investors and invested into a particular theme. And in this particular case, it is the infrastructure projects. Now, when you look at an issue which the money has been raised from public, the underlying SEBI regulations are very clear, saying that those projects have to be completed. They cannot be under construction. They have to be completed projects, and they have to also be generating revenue. So we've seen two such issuances in India right now. One is the IRB, which is into the infrastructure of roads and collection of tolls. The other one we have is an India Trust, which is India Grid Trust, which is the power sector. Now, the minimum investment that an individual needs to make while investing into this through an IPO is 10 lakh of rupees. And once it's listed on the exchange, then the minimum lot size is 5,000 units, which is 5 lakh of rupees. So the question is, the intent has been very clear that this product is in nascent stages. The regulator wants only people who are aware and who are well versed with investment matters to get into products like this, because it's going to be a while before you start seeing those kind of returns coming in from the products, from these particular projects. Now, when we look at the current market rate of these issuances, now IRB, for instance, was issued at 102 rupees per unit, and the current price is between 96 and 97 rupees. So they are clearly below their issuance prices. Now, had it been an individual who does not understand the functioning of the infrastructure funds, does not understand how the revenues are going to be accumulated in this trust, so they should stay away. So if the query is whether you should invest into these kind of investment infrastructure trusts, it will entirely depend on your comfort level, your understanding of the product, your understanding how the revenue is going to be generated. For a layman, I would suggest that you should desist from investing into products like this, because you do not understand it. Do not venture into it. There are better opportunities where you can invest into equity markets through mutual funds, through an SIP route, and generate that kind of returns. Ultimately, for an investor, what you're interested in is the returns that you make on your capital. Now, if that opportunity is available in a very simplified format through an SIP and equity funds, stick to that rather than picking something and trying it out if you're not comfortable.
Yeah, and just to stretch that point forward, even the IRB InvIT fund, the first that was to hit the market, was fairly, the demand was far more sober for the second one. So it was usually subscribed, but then India Grid Trust didn't do too well. And, just to stretch that point forward in terms of some of the other concerns or risks for an InvIT, it is fairly sensitive to the overall interest rate scenario. If the rise in the interest rates could even potentially reduce the spread between the yield of the InvITs and some of the other asset classes like, say, corporate bonds and saving deposit rates. If you could just stretch upon that point, Harshvardhan.
Yeah, so let's look at the revenue model. Now, for instance, the IRB model that we're talking about, the IRB is into road constructions and collection of tolls. So now we have, the projects which have been transferred into this investment trust are those highways which they have constructed on which they're collecting tolls currently. Now, the upside potential for this kind of a product is because we see more of transportation happening, people moving from one cities to the other. They're using the highways. They're using, they're paying tolls. So that is the kind of collection that they have. and we are seeing newer roads which are going to be constructed. So however, those are not going to be transferred into this trust, but we do have a belief that the government is very clearly focused on development of infrastructure. Now infrastructure, why through these trusts? Now the government needs funding for these kind of infrastructure projects, and these become a good source of raising revenue, raising capital for where the existing projects can be refinanced, and the manufacturers have a possibility of using that finance for building something else. So it works both ways, for the government and for the individual as well. Now the question again coming back, if you're going to understand how this completely works, then it might make sense for you to invest into it. But if you do not understand the nitty-gritties, you do not want to get into this, why would you want to venture into something that is is on an experimental basis for yourself? I'm not saying the product is experimental, but if you do not know about it, then you're going to try out, which is not really necessary because there are other products available. So considering the entire structure, it makes more sense to invest only if you're a well-versed investor, if you understand the whole process, not otherwise.
All right, Harshvardhan, it's been lovely having you with us on the show, really guiding all of our investors on what to do while investing in their personal finances. So on that note, from Avni and me, we wrap it up right here on The Money Show. Please do keep sending in all of your queries to us. Thanks for watching.